I know time is short and everybody's busy, so I'm just going to hit you with the punchline first. All right, this is where we are. This is a weekly chart of crude oil. Prices are currently around $86. I think I see the potential for them doubling over the next 12 months. I think if things play out like we saw here in 2007, we could have a sharp rise into the second or third quarter of next year, 2024, and prices could go to new all-time highs. I'll explain more, but basically, this is one of the steps in a multi-step process into a recessionary bear market, which I think we are rapidly approaching. So, all right, with that said, let's get into the charts. All right, over the last several weeks, I've pointed out plenty of charts supporting recession. Here's one more that I thought was interesting. This is the average U.S. mortgage rate, 30-year mortgage rate versus the 30-year Treasury yield. Basically, it averages around 1% most of the time. That's probably the mean. Once it gets above 2%, that tells you things are extended and we're probably headed to some type of recessionary downturn. We had here 99, 2000, we had the tech bust. It got above 2%. It came down, got above 2% again here during the global financial crisis, came down. We had a recession. And then again, before COVID or just during the initial phases of COVID, it got up to a little over 250 basis points. And then it came back down. Right now, we're at 330 basis points or 3.3% above the 30-year yield. This is unprecedented, and I don't know how this will not turn out to be a recessionary signal. All right, on to the next one. All right, so this is the NFIB job openings versus non-farm payrolls. So NFIB stands for the National Federation of Independent Businesses, and the red line is the year-over-year jobs opening line. The black line is the monthly non-farm payrolls. So anytime the red line turns deeply negative like we are now, that indicates a recession. As you can see here by the vertical gray lines, these are all recessions going back to 1980. We are deeply negative again. So what I suspect is going to happen is the non-farm payrolls is going to close the gap. It will come negative within the next quarter or two, confirming a recession and a stock market downturn. All right, now let's switch over to see how the consumer is doing. On the delinquency side of auto loans, credit cards, and consumer loans, they are at their highest level in a decade. Of course, we are much lower than where we were in 2008 and 2009. But I think what is important here is the rate of change here in the rise. This rise since late 2021 is pretty exponential, and I think it's only going to get worse. All right. While we're on the subject of credit card, this is the total outstanding credit card balances from 1999 to present. So as you can see, we breached over 900 billion back here pre-COVID. Government handed out tons of stimulus. Everybody paid down their credit cards, and then we've shot up ever since. The consumer is running out of money. Credit card delinquencies are rising, and we now have over $1 trillion in outstanding balances. This isn't good, especially when I show you where the credit card rates are. All right, so the average interest rate for all credit card accounts, this is going back to 1994. We are over 21% now. Can you imagine that 21, 22%? And especially since the outstanding balance is over $1 trillion, consumers are getting crushed. They're absolutely getting crushed. And when they have to start paying back their student loans starting in October, that's next month, I don't see how we're going to get out of a recession. They're not going to have money to spend, and fewer spending means lower growth, and that equals recession, my friends. Before we get too much further, I should probably share with you. Now, this is my view, but I see generally there are 8 steps that lead to a recession and a bear market in stocks. Number one, the yield curve inverts. That's happened for over a year now. Number two, Treasury yields peak. I think we're very, very close. I thought they peaked last September, but we're seeing marginal new highs now, but I think they're very, very close to peaking. Number three, then the stock market peaks. It may have peaked back in June or July, but I'm not sure. We could see one more higher high maybe in September or October. but I think the stock market is very close to peaking. After the stock market peaks, we see one final flush out in commodities. They surge, and that usually is the force that squeezes the consumer to the final end and pushes us over into recession. I believe that's going to be starting soon. I believe commodities, oil, and precious metals will go to new highs. Once commodities peak, then everything rolls over and crashes together. The Fed panics, slashes interest rates, markets bottom, and then a new business cycle begins. So, like I said, I think we're between steps 2 and 3 right now, and that we are about to enter a final rally in commodities that could last up to about a year. The recent breakout in oil supports this, and we'll get into the oil chart next. But yeah, I think the final surge in commodities is coming. All right, we're going to go back to the original chart I started the video with, and this is a weekly chart of crude oil prices. And what I want to bring your attention to here is down in the bottom panel. This is a 210 yield curve. Okay, so when it drops below the horizontal maroon line, that means the yield curve is inverted. So it went inverted in early 2006 and stayed inverted into early 2007. During that time, oil pulled back to the 200-week moving average, found support. It consolidated for probably almost a year, and then it broke out. It broke out above, I'm not sure what this, $65, $70, and it pretty much doubled to $147. That killed the economy. All right, the official recession started in December of 2007. The stock market peaked in October of 2007, but oil continued. It was, like I said, commodities peak last before the recession. It peaked in, I think, July, and then it absolutely collapsed from there. So where we are now is similar. We have a strong yield curve inversion. It inverted back here in 2022. Prices peaked. They pulled back to the 200-week moving average. They found support. Prices are still inverted, deeply so. And I think we are on the verge. Prices have consolidated for about a year, and I think we're on the verge of a breakout. If we get above $90, say, or $100 running into year end, I think there is a good chance we're going to probably maybe go to new all time highs in 2024. And I think 165 is a possibility. That would kill the economy right into a presidential election, by the way. And then we would have a collapse in oil prices, I assume, into year end. So we'll have to keep an eye on this. Before we go, I want to touch on the gold price because I think it's going to have a nice rally here, too. So let's jump over to that. Okay, last but not least, we have gold. This is a weekly chart. Prices are around $1,940, roughly. That's futures. What I want to point out here is the 3 year consolidation. So we had the same thing from 2016 to roughly 2019. Price gets consolidated in A, B, C, D, E. All right, we have the same thing now. 2020, it's in 2023. We have an A, B, C, D, E. I think the final pullback was here, but I would not be surprised if prices come down a little bit further as long-term yields rise. They're threatening to go to new highs. As you can see here in the lower panel, the 10-year yield is rising, and that is putting pressure, temporary pressure on gold. As I said before, step 2 and 3, we got the treasury yields will peak. And once they do, then the stock market rolls over and then we get the final surge in commodities. So I'm still expecting that. I believe gold is going to break out to new all-time highs either later this year or early next year. And what we really need to pay attention to is when it gets above, we'll just call it $2,100. Once it gets above $2,100, I believe the train is going to leave the station. And I think that we could near maybe $3,000 by this time next year. I know that's a bold call, but that's what my charts tell me, and that's what I'm going to be looking for. But first, we got to get this breakout above $2,100, which could come as soon as October. Again, it all depends on when long-term yields finally peak, which hopefully will be soon. So that's it for now. If you like this kind of content, hey, subscribe, hit the thumbs up. I appreciate it. At Gold Predict, we release 3 market updates per week. We have a little educational portfolio for those interested in trying to learn more about when we time the market and what we buy and when we buy it. So if you like that kind of stuff, hey, come check us out. We offer, I think, very fair pricing. So I appreciate your time. I hope you're doing well. God bless and bye-bye.